What I want to talk today about is leveraging home equity in retirement. How we're going to do that is leveraging a reverse mortgage. So in layman's terms, I want to keep more assets under management for you guys, for your senior clients, by using home equity as a buffer asset earlier in retirement as opposed to later. What is a HECM reverse mortgage? HECM stands for Home Equity Conversion Mortgage. It's an FHA loan program regulated by the government for homeowners 62 and older to access home equity while living in their primary residence. There's no monthly mortgage payments made on a reverse mortgage, so it frees up cash flow. There's flexible options with a HECM, so we can do a line of credit, we can do a lump sum for the equity in their home. There's ways, we'll get into this, how we can leverage it. So the stress that we're seeing on seniors trying to live off Social Security, pensions, and maybe a minimum required distribution is not keeping up with the rate of cost of living and specifically inflation. One that's always locked up or we don't know how to leverage the best or when to leverage it comes in at the senior home equity. The senior home equity represents about $11 trillion in retirement assets. It's about equal to all of their IRAs combined in the United States for seniors. So how do we get that money? How do we use it? Keep the investment money with you guys while still taking care of the client. What used to be go get a HELOC against your house, a line of credit, it works for some people but not all, and it specifically isn't the best option for seniors for a multitude of reasons. On a HECM line of credit or a reverse mortgage line of credit, there's no monthly mortgage payments required. They're optional. You can use it like you would a credit card or line of credit. Well, on a traditional HELOC, the lender has the ability to snip and trim that line as market moves, and they were required to make a minimum payment on that credit line to service that debt. Where with the reverse mortgage, the interest is tagged on the back of the loan for when they depart the residence. If we can open the line of credit, knowing it grows, it can be a really great way to watch that line of credit. So even if we open it up when as they turn 62, we can eliminate the monthly mortgage payment, open the line of credit, and watch the line of credit grow over time. Let's say the market starts to run the next 2 years and it's no big deal to take a distribution from that. Home prices are appreciating, then you and I, if we're taking care of Susie, we could collaborate, put heads together on, is it right to pull from the line of credit or take our distribution this quarter? Where's the market going? How are they hedged? And what would it look like? So recommending that we open the line of credit earlier, whether or not we leverage it immediately or not, is recommended to give that senior flexibility to meet their needs and how to keep them liquid as they go deeper into retirement.
Have you ever leveraged these for a client that already owns a home outright and then see them take one on like this as just, to your point, just another form of liquidity that's not liquidating your IRA? Or
they're the senior population, they've paid off their house, they're very proud of it.
Of course.
But it's captive cash. You're sitting on $500,000 with nothing to do, running out of investments in Social Security's and retirement accounts. Great, your home is worth $500,000 or $1 million, but you can't do anything with it.
Sure.
We can't leverage it. We can't use it. So a lot of this is trying to get people to understand there's a lot of negative connotation around reverse mortgages. 2014, it really underwent full kind of restructuring, reorganizing guidelines of what mortgage companies can and can't do to serve a senior. It's a protected consumer class, as we've mentioned. So we're really bound by what we can and can't do with them. So we're going to get into the coordinated withdrawal strategy, how to use it, why to use it. The flow is very simple. Establish the HECM, review the portfolio up. And when the portfolio goes up, take withdrawals from investments. When the portfolio is down, we can take withdrawals from the HECM or the equity in your home in its simplest form. Okay, this illustrates from 1973 to 2002, just to give us a market return look at how the market performed and what it would look like if we took out a reverse mortgage or HECM as a last resort, starting in 98 at age 87. As the portfolio, we continue to take money from this retirement account and keep working value the portfolio and taking our distributions, we can see that after X amount of years, you guys aren't making money to keep this client. It's not really worth your time now and investment on keeping this client, just to be frank. As they continue to pull from it, the market will have good years and bad years, we all know that. But if we can leverage this earlier, I'm going to contrast how we can keep more assets under management by using the line of credit earlier as opposed to later. So as you can see, by the time they're 87, now we're trying to pull from the line of credit too late. We have roughly $12,000 in asset under management. It looks like Susie's going to live 10 more years, and we don't have enough cash to make sure we're taking care of Susie the right way. Using this strategy, the portfolio becomes exhausted after about 25 years. And then by this point, it's costing you money to keep them as a client. Use it as part of the coordinated withdrawal strategy. If we can put the HECM into place earlier in there at age 62, 63, 64, 65, as we have down market years, instead of taking a distribution, we can take cash out of the line of credit, keeping the portfolio value higher. On the far right-hand side, as the portfolio grows, we're pulling from the line of credit on down years or bad market return years. The assets under management can stay higher. And this is the heart of what I want to get into today, is keeping more assets under management for you guys, taking care of the client safely, securely, and putting them in the best position to end retirement the right way, on a high note, and not a panic or burden for their family.
So largely the HECM would go untapped, except for, the years by which, where, let's just keep it simple, stupid, the market's down, you don't want to lean into your investments when they're down. This gives you another pool of equity to then lean into. So the line's always there, and then growing kind of in the background, largely in the years you're not using it.
Yes.
But then intermittently, when you have turmoil in the equity markets or what have you, you then, in this case, 4 years out of 20 or however many that shows.
Yes.
Okay.
We have proprietary products as well that go down to 55 years old. It's more of a unique situation, but we do have products for people 55 and older. The other one is, sometimes if there's not enough equity in the home, if there's not enough equity, you can bring cash into closing to make that equity gap make sense. I don't always recommend that, but my favorite reverse mortgage we did, someone did the reverse mortgage, took out the line of credit, and they used like 30 grand to take all the extended family on a vacation to Hawaii because they wanted to build a legacy. This is how I want to be remembered. So going back to what the funds can and can't be used for, there's no restrictions on what you use that line of credit for. My grandma came from the mortgage industry. She was the first female board member of a mortgage company in America. She helped securitize mortgage loans into bonds. So the day she turned 62, she closed her reverse mortgage. She's like, this is the greatest thing ever. Everyone should be doing this. Yeah. But her home, she still has the same equity position that when she started. Mm-hmm. So she's a big proponent. We have other past clients that people are, want to hear it from not the guys doing the mortgage or want other success stories. We have those as well that we'd be happy to share or get them in contact with, of things people were scared about. Most of the time after a conversation, we can calm those fears and help it make sense. The takeaways that I wanted to give you guys today: consider their goals, understand how they want to spend retirement, identify potential concerns about health, longevity, loss of spouse, examine their assets property, liquid assets, monthly income, whether that's PERS, pensions, IRAs that they take income from, determine asset sustainability, calculate how long current projected withdrawal rates are expecting for the longevity, and then establish that financial security net. Implement the HECM strategies to hedge asset market volatility.